Hi everyone, this is Catherine Tindall giving you the follow-up video for the Q&A. You're seeing this because you attended the webinar I did last Friday on September 29th. Please also check your email. We have sent out a copy of the tools that I promised, as well as a copy of the slides from the original presentation. But these were the questions that people had asked that didn't fall under the explanations within the presentation, and then also certain individual questions were a little more complex, so I just reached out to those people individually. But these are the general purpose ones that I wanted to address for everyone, so let's get into it here. Does the IRS have a Where's My ERC Refund website? Not that I'm aware of. I don't think they have this. I don't think they're going to build this. The best way that you can find out what's going on with an ERC claim is to call them directly, but I can tell you in advance basically what they tend to say. So the first thing is when a claim comes into them, it goes into scanning, and then the return gets scanned and it gets logged to the account under the EIN as waiting to be processed. And so for most of the time, if the claim is unprocessed, that's the only status that they'll be able to see. They'll be able to let you know if it's been assigned to someone for processing. But at this point, given that this is after the moratorium announcement, we really have no timeline expectation on when things are going to be processed. Now, if a claim has been processed for a quarter when you call in, they will be able to tell you if the claim has been escalated to a second inspection. They'll also be able to tell you if the claim has been processed, and if there was a problem with it, they'll be able to give you details on the notice that was issued and what was contained in the notice and what were the findings there if there was a problem with it. If there was no problem with the claim, then the claim will get processed, and then they'll have a check issue date, and they'll be able to tell you when the check was issued. They'll also be able to tell you where the check was routed to. And this is for each of the quarters that a submission is done. So you would have to ask for each of the quarters. Now, for tax professionals that are helping clients with this, you'll need to have a power of attorney on file that specifically calls out the payroll tax returns and the time periods of 20 and 21 that you're allowed to discuss the account. You'll need to have that. It's a Form 2848 power of attorney with the IRS. And in order to have that, you need to be a CPA, an EA, or a lawyer to have that. And that can be helpful if you get those in advance. Now, if you don't have it already filed online with the IRS, you'll need to be able to fax it to the agent when you talk to them. You can also utilize the IRS practitioner priority hotline. You can just Google that for the number there. That's a special line for tax professionals to be able to use that. Now, hold times right now are really long. And basically, in my practical experience, the only really way to know what's going on is to call in, and they really can't give you any more. Typically, if it's unprocessed, the only thing that they can really tell you is that, yes, they do have a return on file waiting to be processed. But until it goes through that processing, they won't be able to give you any more information. And then the last couple, I've been on the phone with them for a couple hours today. Basically, at this point, because of the moratorium, they're not currently, as of the timing of this recording, able to really give out timelines on when they expect things to be processed. Now, if you have something where there was an IRS error on a really old claim that was filed, you can get the taxpayer advocate involved, and you can just Google that as well, which is an outside agency that helps work with the IRS. You might want to contact the taxpayer advocate to get involved if something's been seriously messed up on the IRS side. But for the most part, we're just seeing that claims have been pretty delayed, and then with the moratorium, they're going to continue to be very delayed, even if they were in processing before the moratorium announcement. An LLC business was formed in 2019 with minimal revenues, approximately 75K, reported a loss with startup costs in the 2019 return. Can this fall under the startup rules if not fully operational in 2020? So this would come down to the question of when is it an active trade or business? The fact that they do have revenues, even though it's not at obviously their full capacity, would indicate to me that they were an active trade or business in 2019. And so what you'll want to review is in the slides, we put the link for this, but you can also just Google this, is the IRS Notice 2020-21. And the question in particular that you're going to want to look at is question number 27. That will give you the details of what you need to do for comparative revenue testing to do the revenue declines, and then for the government order restrictions and what's going to work for that. I refer back to the slides. In a lot of these cases where you've got kind of a partial year going on in 2019, and maybe the comparative periods are a little weird because you don't have a one-to-one like a business that was fully operational in 2019. You'll want to just have a professional take a look at it and compare it. But if you, at least for the revenues part of it, reference that question 27 in the IRS notice 2020-21. That'll give you how to do the revenue comparison. But if you were fully operational, if you were operational enough in 2019 and considered an active trade or business, then no, you wouldn't fall under those recovery startup rules. Okay, next one. The 2021 entity return statute, and this is talking about the income tax returns, expires on March 15th, 2024. It just depends on when it was filed, but therefore, what happens if the amended return can't be filed by that date? Now, for the most part, with the statute of limitations expiration, most of these 2021 returns are going to be balance due returns and not a balance refund because you're reducing a wage deduction. So even if you're technically out of the statute of limitations, I would still do that filing just because it is a requirement for 280C. And if there's an additional tax balance due, get that sorted out. So really the statute that you've got to watch out for is to not miss the ERC statute of limitations, because that's a refund balance back, right? So you want to make sure if you are doing these filings that you're sending them certified, so you have a mailbox rule proof of receipt to the IRS. You'll also, if it's getting kind of close to the statute, you want to call and make sure that they have it logged for, logged that it's unprocessed, but that they have a record of it, so that if there's some issue with it, you can show that you came in before the statute of limitations. Because like I mentioned, for 2020 claims, that statute of limitations is going to start in April of 2024. And then with all of these processing delays and issues, if you have a claim that's kind of coming in late, it's not, you can submit it before that April date, but it's probably not going to be processed before that April date. So you just want to be very careful about making sure that you've sent things certified, that you have a proof of delivery. And then also, I think it's a best practice to just call in once you've got that certified return receipt back, just to verify that all of the quarters that were remitted to them, they do have logged as waiting to be processed, and that the dates that they have are before that statute of limitations, so they don't just kick out a notice to you, say, hey, this is beyond the statute, we're not going to process it, and then you get stuck in a back and forth with them. So those are all best practices on that side. But for the actual income tax returns, because most likely those are just balances due, it's the statute's not as big of a deal, just because you're making a payment in. All right, next question. Did I understand correctly that the wages of a single 100% owner of an S corporation are not eligible? Yes, you did understand correctly. So basically, if you have an S corporation where it's just one of those, saving some Social Security tax arrangements, those wages are not going to qualify. Same thing if you've got, say, a husband and wife duo running an S corporation and they're taking wages and there's no other wages, those are not going to qualify, because when you have that over 50% ownership of an organization, when you flow it down, if you have that over 50%, then those fall under the related party rules and those wages don't qualify. Is there a maximum number of employees to apply? The answer is no. I'll address the minimum as well, because I think that might have been what this actual question is about. So basically, you have different rules for large employers versus small employers. And like I recommend in the presentation, if you've got a high head count within a company or within the portfolio of companies that's needing to be aggregated, there's a lot of special things that, the rules work differently for what's eligible wages. It gets significantly reduced. But the bigger issue with that is, well, how are you counting people? And there's special rules around, well, what counts as a employee for this? How part-time are they? How seasonal are they, et cetera? And so I just recommend, with the sheer volume of, when you're in those high head counts, that you really just need a professional doing that full assessment on your organization, and do not try to DIY do that eligibility assessment yourself, just because I've seen people I've seen people say, oh, well, the head count, it's 100 employees in 2019 and we had 120, so we don't qualify. And it's like, well, actually, when you do the testing correctly, you're only at 70 or you're only at 50, so you do qualify. So I would just say don't even try to pre-qualify yourself on that one, but just know that it is different rules. The kind of bright lines is 100 and 500, but I would say just if you're anywhere close to 100, just know that you're likely going to get caught into different rules, but that the program, you really should take the program seriously if you're at those high head counts, because you're now playing with life or death with $1 million tax credits. And that's something where you just need a professional assessment done. Now, on the flip side of that, the minimum number of employees, which I'm guessing this might have been what the real question was, because sometimes people see, in some of these companies that advertise, oh, you need at least 5 employees or 10 employees. It's not true. So basically, how it works is once you have an eligible window, any eligible wages, and, referring to like what are, non-family members, non-PPP, the eligible wage base, any wages that are considered eligible are eligible for the credit. Now, are you going to file for $1 tax credit and then have to amend income tax returns? Probably not, right? So it's a cost benefit analysis. And that's why I say for most organizations, you definitely want to take this seriously if you were impacted very seriously and you have at least 5 employees, because that's where the cost benefit of doing the filings, doing the amendments, all the administrative burden starts to make sense. So it tends to be around 5. But that's not a limitation of the program. That's more a practicality limitation. So just know, the first dollar that you have of eligible wages is eligible for credit, but it's just when you consider amended income tax returns and then all the, fuss and muss that goes into these, you want it to be worth your while before pursuing it. And so that's why I usually say, it's when you're up above 5 employees, that's where you might want to consider having an assessment done. And especially if when you look at your revenues, if you had some serious revenue hits, so you're qualifying in multiple quarters in 21, since that's where the bulk of the credit is, you'll definitely want to get it checked out. But if you only have, say government restrictions for 2 weeks with 4 employees, that's not going to yield you very much of a credit. So it's a facts and circumstances thing of the is it worth it analysis on these, but there is no program enforced minimum. It's just practicality. What if you have NOLs and the adjustment would only affect the NOL carry forward? Can you then include in the 2023 return? Yeah, so this is just one of those questions that I get where, it depends, what's administratively correct versus, if there's no tax change, can you just file it and then, include a statement? I guess it just depends on what's going on with the NOL and how much of a risk you want to take with potentially having an issue there, especially if it's a no tax change. But I think the bigger question here is really just, like I mentioned in the presentation, you have to realize that an ERC credit is not a standalone filing, because it interacts with the rest of the income tax reporting situation. You really have to consider the impacts of all of these other things, like if they have NOLs, if they have if they had public health benefits or, health subsidies and it's in a pass-through entity, if they had ownership changes in prior years, all of these kinds of other complications can come into this process that you really need to consider before you do any ERC filing. So that's why I think it's important, for anybody considering doing this program, you really know the full scope of how this is going to interact with the income tax situation in those prior years in 20 and 21, if that's what you're qualifying for. And make sure that you really have that pinned down before you submit an ERC filing, because once you submit that ERC filing, you're now in the ring and you've got to get those amended returns done. So that was it for the questions. Pretty short list today. So I want to again thank you for joining on the presentation last week. And then there's going to be a link below to get in touch with us. If you would like to have a assessment done on your individual situation, or if you're a tax professional and need guidance for other clients or other situations, we're happy to be engaged for a consulting engagement. Again, thanks for joining, and you'll be added to, feel welcome to unsubscribe if you're not interested, but we really respect your inbox. And as we get more updates from the IRS with things like the moratorium announcements, the settlement program, some of the changes that are happening over there, I was very happy recently to see they're making improvements to the tax pro accounts. we'll keep you updated as this program's evolving, and as we're starting to get more information about how things are changing, just so that you can know what's going on in the landscape here. So thanks again, and we'll see you next time. Have a good rest of your day. Bye.